Hey everyone, and welcome to The Explainer. So today we're going to dig into a question that really challenges a core belief of long-term investing. We're always told to just buy and hold, right? Just ignore all the noise. But what if that noise, specifically market volatility, is actually a critical signal we should be listening to? Let's find out.
Okay, picture this. It's October 2008. The entire global financial system is on the verge of collapse. Markets are in an absolute freefall, and panic is everywhere. And right in the middle of all that chaos, this was the advice from top-tier economists like John Cochrane. It was the standard playbook. When everyone else is scared, you should be buying, especially if you're in it for the long haul. And that was the million-dollar question for every single investor. I mean, on one hand, you had volatility shooting through the roof, which screamed extreme risk. But on the other hand, with stock prices plummeting, valuations were starting to look unbelievably cheap. So what do you do? Was this a total catastrophe you needed to run away from? Or was it the buying opportunity of a generation? So this brings us to the first part of our story today, the established, tried and true advice for anyone investing for their future. And the mantra was simple. You've heard it 1,000 times. Just stay the course, ride out the storm. And the logic behind this is really seductive. When volatility spikes, it usually means the market's down, so stocks are basically on sale. Plus, we all kind of believe that over the long run, stock returns tend to find their way back to the historical average. That idea of mean reversion. So if that's true, any short-term roller coaster is just a tiny blip on your way to long-term wealth. So if your goals are decades away, why worry about the scary headlines, right? Just ignore the chaos and keep on buying.
But here's the thing. Is that logic actually sound? Is it correct? Well, that's the exact question at the heart of the amazing academic paper we're breaking down today. A couple of researchers, Alan Moreira and Tyler Muir, decided to stop guessing and put this conventional wisdom to a hardcore quantitative test.
And they didn't mess around with opinions or simple rules of thumb. No. They built a seriously sophisticated model using nearly 100 years of U.S. stock market data, all the way from 1926 to 2015, to figure out mathematically what the actual optimal strategy is when you're dealing with all this market turbulence. And this, my friends, is where our story takes a really fascinating turn. Because when they ran the numbers, the data told a story that pretty much flies in the face of decades of financial advice. Turns out, the best thing for a long-term investor to do, well, it's probably not what you're thinking.
That's right. The paper's big conclusion is that the whole do-nothing, ride-it-out strategy is a profoundly expensive mistake. In fact, they found that you should be actively managing your exposure to volatility.
Okay, so how costly are we talking here? Well, the researchers actually put a number on it, and frankly, it is jaw-dropping.
A long-term investor who just sticks their head in the sand and ignores volatility is giving up the equivalent of 2.4% of their wealth every single year. I mean, to put that into perspective, that's more than you pay in fees for most investment funds combined. It's like having a massive invisible leak in your portfolio year after year after year.
All right, so we have to ask, how could such a basic, widely held belief be so wrong? Well, the researchers pinpointed a really fundamental flaw in how we've all been taught to think about long-term risk. The core mistake, the big misunderstanding, is that we've been confusing two totally separate things: the average amount of stock you should own over time, and your immediate reaction when a big volatility shock actually hits the market. They are not the same thing at all. Now, this slide here really helps visualize the problem. So pretty much everyone agrees that a short-term investor should dial down risk when volatility goes crazy. But the old wisdom said a long-term investor, who naturally holds more stock, should just sit tight. Well, the research shows that's just wrong. The optimal move for both investors is to cut their stock allocation and cut it sharply. The only difference is that the long-term investor starts from a higher point. The key is that their reaction, the percentage they sell off, should be exactly the same.
So that old logic really has two fatal flaws. First, it gets the timing all wrong. See, those big volatility spikes, the market crashes, they're usually intense, but they don't last forever. But the higher potential returns that often come after those crashes can stick around for a long time. This means you can actually sell during the peak of the storm, wait for things to calm down, and then get back in to capture that upside without taking the full hit. And the second flaw, like we just saw, is confusing your overall plan with your immediate reaction. I mean, just because your long-term plan is to own a lot of stocks doesn't mean you shouldn't swerve to avoid a sudden pothole right in front of you.
So, if the old way is wrong, what's the right way to do it? Well, what's so great about this paper is that it doesn't just tear down the old theory, it actually gives us a new one that's surprisingly simple and, well, elegant. What the researchers discovered is that the perfect, mathematically optimal portfolio can be almost exactly replicated with a simple two-part approach. So think of it this way. One part of your portfolio is your classic set it and forget it, buy and hold strategy. But you have a second, dynamic part that acts like a risk dial. You systematically turn down your stock exposure when volatility spikes, and you turn it back up when things are calm. And here's the crucial part. You don't need some complex algorithm or a PhD in finance to get this right. This simple two-part framework gets you almost all of the benefit of the fully optimal strategy. It basically makes smart risk management accessible to everyone. And this chart, wow, this chart really just says it all. You see, when we hear market timing, we usually think it's about trying to predict where the market's going next. But this research shows that a whopping 80% of the benefit from a smart timing strategy comes from just reacting to changes in volatility, the risk you can see today. Only a tiny 20% comes from trying to guess future returns. And that, right there, is the single most important lesson from this entire analysis. If you take away just one thing, let it be this. The data is crystal clear. The biggest impact you can have on your long-term results isn't about gazing into a crystal ball, it's about reacting intelligently to the risk that's right in front of your face. So this research pretty much flips a foundational piece of investment advice on its head, and it really leaves us with a powerful final question to chew on. If this idea, something so deeply ingrained in how we think about investing, is so demonstrably wrong, what other pieces of financial wisdom that we all take for granted might also start to crumble if we just took a closer look at the data?